as it stands here today, it appears we've hit a local bottom in Bitcoin down at the $75,000 range, and we've recovered from that, and now we're bumping up against some serious resistance at the $88,000-$90,000 level, and we've got to kind of break through that mentally and hold that for this to stand. But I think that Bitcoin's catching a wave like similar to gold, where you've got investors who are putting money in both gold and Bitcoin, and that the US dollar being weaker is making Bitcoin stronger as well. And so it's a long way of saying that the decoupling, I appreciate it. I like it. I want to see it continue. And we're going to have to see, weeks and months of this for it to really hold.
The crypto market is heating up as Bitcoin hovers at a pivotal point, on the verge of either a major breakout or yet another disappointing pullback. After rebounding from a local low around $75,000, Bitcoin has fought its way upward, only to hit a massive resistance wall between $88,000 and $90,000. This isn't just a routine price barrier, it's a crucial threshold that could determine whether Bitcoin launches into new all-time highs or gets rejected back into consolidation. This rally isn't happening in isolation. A weakening US dollar and surging institutional interest are providing strong tailwinds, echoing gold's recent rise as investors seek safe havens amid economic uncertainty. But as analyst James Lavish notes, the real challenge lies ahead. The market has shown strength, but pushing past $90,000 and holding that level requires more than just bullish momentum, it demands conviction. Traders are closely watching to see if this is the start of a true decoupling from traditional markets, or just another short-lived pump. The stakes couldn't be higher. A breakout above $90,000 could ignite a wave of FOMO and send Bitcoin soaring, while failure might lead to another period of frustrating sideways movement. One thing is clear, the coming weeks will be critical. Bitcoin's next big move is on the horizon. Buckle up. Let's dive into more from James Lavish's explosive insight.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
The divergence from Bitcoin and risk-on assets like the NASDAQ and regular stocks, at the same time that bond yields are going down. Actually, I'm sorry, the bond yields are going up, so bonds are going down. So you would think that the flight of safety would be to bonds. And for people who are new to this whole game, when you buy bonds, you're buying them at above or below par, right? And if you buy it below par, that means you're buying it at a discount, which means that the interest rate you're effectively paid, because you're getting paid coupons on these things. Those coupons are set. So if you paid less for the bond, then that coupon becomes just a larger percentage. And so that's why yields go up when bonds go down. And that's kind of the way it works, right? So, but you would think stocks going down, well, then bond yields would probably be going down too, because bonds are going up, because that money would be flowing into safety assets, like the risk-free asset, which is the US Treasury. Not really risk-free. We know that. We talk about that all the time, but that's the quote on Wall Street. Risk-free is the US Treasury. It's not. It's not risk-free. We learned that the hard way during the pandemic, when we way overprinted money. Not we, the central bank, the Fed, way overprinted money, caused massive inflation from the expansion of the money supply, massive asset inflation, massive inflation across financial assets. And because we're so financialized as a nation, everything went up in price, along with supply issues and supply chain issues and bottlenecks and all that. But that was kind of a goat that should have gone through the boa and gotten out the other side. It never did. And we had these this crazy inflation for years and years because of the expansion of the money supply. Let's just call it what it is. So you saw bond yields. What happened was bond yields spiked because Fed funds went up and bond yields went up in order to compensate investors for that high inflation. So if you're a bond trader, you're not going to buy a 10-year treasury at 2% if inflation's at 5%. You want to be compensated for that. And so when that interest rate goes up, the bond price goes down, and all these banks, all these community banks that were holding these treasuries got absolutely annihilated. And that's ultimately what caused the collapse of Silicon Valley Bank 2 years ago. And that's kind of, if people remember back, well, that's not risk-free to me. That sounds risky to me. It's risk-free in the sense that, yeah, if you hold it to maturity, it's a non-zero probability that the U.S. will hard default on that, but it's about as close to zero as you can think of, because the U.S. Treasury has the ability to team up with the Fed and print money to buy its own bonds. So of course they're not going to default. They're just going to print money and make sure that these things are always trading. And so, that's it's called the soft default. And that soft default is inflation through expansion of the money supply, which is debasing the U.S. currency every single day in order to keep this whole debt charade going. And that's kind of the point, right? Big picture, what's been happening? Well, Trump has threatened to enact to enforce these tariffs on all these countries, and big tariffs. And so that has caused quite a bit of angst for a number of reasons. There's angst with people who import materials and goods to sell here in the United States. So you getting some misinformation of the actual demand, the underlying demand of the economy, because you've got manufacturers and suppliers who are importing goods in order to get ahead of that tariff. The underlying economy has not been doing that great. There's a lot of negative indicators out there. And so we're just watching these things and seeing if they continue to kind of snowball, especially things like the unemployment rate, now that you've got government jobs coming out and all of that. But so you've got the economy is clearly softening. You've got cross current of information of what are the actual trade numbers, what are the actual purchasing and index and the PPI and all that. Like what's PMI, all like what are all these telling us? And then at the same time, you've got investors who are worried that the earnings of companies are going to get negatively impacted. At the same time, you've got bond investors worried that, well, if we're going to hammer China with these huge tariffs, they're going to turn around and they're going to shore up their own currency, and they're going to turn around, and the way they do that is by selling treasuries that they have. So if they sell U.S. treasuries, what does that make the treasury do? It goes down in price and yields go up, something we may be seeing here, right? And so, or it could be traders getting ahead of that, worried about that scenario where China starts selling bonds, and not just China, other countries too, selling U.S. treasuries in order to get dollars to sell those dollars and buy their own currencies. Those are possibilities. You're seeing the dollar go down in value against other currencies across the board here. The DXY is down, and that suggests some of this is happening, or just the confidence in the U.S. dollar, the U.S. Treasury is waning. That's all happening. And then you layer on top of it, Marty, that basis trade I was talking about. And that's kind of like the powder keg that is behind the scenes that the very, very intelligent investors know about. They understand it, and they're watching carefully. They're watching credit spreads. They're watching the spreads of the bonds to the futures, the bond futures, and they're gauging whether or not this trade has is going down the path of blowing up in hedge funds' faces. We're watching all this, and I don't know if these trades are being unwound, but I can tell you that there are hedge funds that are anticipating problems of other hedge funds with them, and so they're getting out of some of these trades, and that's why you're seeing some of the movement in the yields, I believe. And so, but what's happening is, and what's so important about this is that this is to get an idea of how impactful and how explosive this trade is. They had the Brookings Institution. For those of you who don't know what that is, it's a think tank out of DC And it's basically a tacit research arm of the Fed. I mean, that's a very strong statement. But what I mean by that is that there are a lot of former Fed officials that work at Brookings Institution, and they research and float ideas and policy there to kind of see how they're received, and what people think about it and what the Fed thinks about it. And so for instance, they did, and I've said this before, the Somm rule, the Claudia Somm worked at Brookings Institution. She was a lower Fed official. She worked at Brookings Institution. She came up with something called the Somm rule, which is that unemployment rate rule that to keep the numbers very simple for everybody, basically if the unemployment rate goes up by more than 0.5% from the bottom in a cycle, that means we're in a recession. We've gotten very close to that. But that's a rule that the Fed looks at now. That's something they use as a gauge to say, okay, we're in recession. We've got to lower rates. They haven't seen it yet. It's very close, but that came out of the Brookings Institution.
The crypto markets have just exploded in a historic liquidation frenzy, wiping out over $500 million in short positions as Bitcoin's relentless rally left traders in disarray. The next crucial battle is at $95,000. A possible pause point before the final push to the ultimate psychological barrier, $100,000. But this isn't just another price move, it marks the start of a monetary revolution. The total crypto market cap has surged past $3 trillion, matching the heights of the 2021 bull run. However, this time, the momentum feels different. Macroeconomic forces are aligning in unprecedented ways, with 10-year Treasury yields approaching 4%, the Federal Reserve hinting at 3 to 4 rate cuts by year-end, and global liquidity soaring at levels not seen since Bitcoin's early days. The stage is set for a financial shift that could redefine markets. The most electrifying prediction? Bitcoin could double before 2025, reaching $200,000, a move that would solidify its position as the ultimate store of value. The real shockwave, however, is the shift in investor sentiment. Crypto is no longer viewed as a speculative gamble. Instead, it's becoming a hedge against systemic risk as traditional markets struggle with inflation, debt crises, and geopolitical instability. Bitcoin is emerging as the safe haven of the 21st century. Let's dive into more insights from the interview.
Is there any feasible way to unwind that trade outside of overt intervention from the Fed?
Not rapidly, not quickly. I mean, it could be catastrophic to the market. Yeah. So you've got it. I would imagine some of these, some of them are unwinding some of it, but I'd also imagine, Marty, that you've got hedge funds who are stepping into it. Like they're looking for opportunity. If they see an opportunity, they think that they can stomach, they're going to step into it. So it might just be moving from book to book. We don't know. It's hard to tell, and so much of it is on swap. It's hard to tell. We're so financialized, like I was saying, as a country, as an economy. If the stock market blows up, really blows up, we are headed for a deep recession. And the only way we can pull out of that is by printing more money. So what happens to bond yields? Bond yields will go up in that scenario because the bond traders, the vigilantes, are going to want to be compensated for the clear and obvious inflation that's going to come from another expansion of the money supply. And so that's the issue here. So do bond yields go down to 2% because we just slowly grind into a recession here? Or do they spike up to 5-6% because we have blown up the economy and the Fed's turning around and printing money to oblivion to save it? It's a good question. And that's why you're seeing a lot of uncertainty in the market. People don't know where we are on that spectrum. And some of it has to do with, headlines and a tweet, from Trump. He could just tweet something that just spooks the market to the point where, you have the NASDAQ sell off 3 or 4%. Oh, well, look at that. It's down 2.5% today. It was down over 3% earlier, I believe. The telling thing is that bonds are not acting like they should as a flight to safety. That's number one. And number two, gold is absolutely ripping higher, rocketing higher.
The crypto market is at a pivotal moment as Bitcoin surges past $95,000, returning short-term holders to profitability, a typical sign of major rallies ahead. Long-term investors have quietly accumulated 363,000 Bitcoin since February, with fresh capital entering at higher prices in April. This accumulation phase aligns with analyst James Lavish's view of Bitcoin's growing role as digital gold, especially as it decouples from traditional risk assets. However, challenges lie ahead, with a strong resistance zone around $97,000, where break-even sellers could emerge. Bitcoin's momentum is now largely driven by institutional adoption, especially following the repeal of SAB 121, which enables major banks to custody crypto. Macroeconomic factors, such as a weakening dollar and bond market turbulence, further amplify Bitcoin's appeal as an uncorrelated asset. The road to $100,000 will depend on whether new institutional demand can absorb potential profit-taking, with on-chain metrics showing strong conviction among holders and whales absorbing 300% of annual issuance. The path forward is uncertain, with market structure suggesting either healthy consolidation or a deeper correction. The rally stands apart from previous cycles, as it's driven by institutional interest rather than retail mania. With Bitcoin's foundation looking solid, the coming weeks will test its maturity as an asset class. Will Bitcoin break through $100,000 this cycle, or are we due for a major correction? Let us know your thoughts in the comments below.
For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.